how to invest in Malaysia with little money. Now I'm going to tell you the truth and the nothing but the truth. Now first of all, you need to understand what is called investing with little money. Well, it could go as little as 1,000 ringgit. Now if you only have 1,000 ringgit, I'm going to tell you like, well, this is probably not your best option to go and start investing just by having a 1,000 ringgit in saving. But the thing is, if you insist, I'm going to tell you your options on how to invest in Malaysia with little money. Now, the first thing, of course, you can invest in is stocks in the share market. Now, the second thing is REITs, or real estate investment trust. And people might tell you, oh, ETF or exchange traded fund is also a good option because of its low fees. And then the other thing is, everybody knows this already, is unit trust or mutual fund, right? And you can get this from a lot of banks or unit trust, fund house. There are a lot of unit trust agents out there. And of course, people are saying that, oh, something very sexy comes along, what we call P2P or peer-to-peer lending. And then of course, there's this traditional, everybody knows, that is the fixed deposit giving you a 3% per year. And some might even take this seriously to say that if you only have 1,000 ringgit, you better go, buy a lottery ticket at Toto, Magnum, or Tamazai in Malaysia. Now, the truth is, this is absolutely a myth. It's untrue. It's incorrect. Because what I just told you about stocks, REIT, ETF, unit trust, P2P lending, fixed deposit, or even Toto or Magnum, they are not really the things you can invest in, because stock, REIT, ETF, and unit trust, they are in the same category. This is what I'm showing you here. They are all what we call as equity, which is called the ownership of a company. Now, you really want to understand when you invest in stock, it is about buying a small stake or ownership in a company. Now, I explain this very clear over here. Now, if you just click on after this video and just check out what is popping up at the upper right hand corner, and you can see this is one of the most comprehensive Bursa Malaysia tutorial or stock market tutorial of what is a stock is about. Now, to tell you that you can invest in this, imagine is to tell you that, well, what can you brush your teeth with? And you say that, oh, they are Colgate, they are Dali, they are Sensodyne, they are Fresh and White. Now, this does not give me, if I ask you this question, if I were to give you this answer, you ask me this question, that's not going to give you the right answer, because these are all toothpaste, right? So people say that you can invest in all this because the thing is essentially the same. It's toothpaste. It's just that it's what differentiate different toothpaste like Oral-B, Colgate, Sensodyne, and Dali. It's about packing it in a different manner, but essentially they are still toothpaste. So it really boggles me when people say you can invest in stock, REIT, ETF, or unit trust, because essentially they are the same thing. It's just a different packaging. Now, so this is why so many new investors got it wrong, and there's a lot of misinformation out there. If you have watched some videos on YouTube, which is raking up a lot of views, and they tell you can invest in those, they are incorrect, right? They are incorrect. They don't know what they are talking about. Because essentially, let me put this for you and tell you the truth. You could actually invest. Number one is what we call as asset class, which is equity. Now, equity, it could be direct into stocks, right? And to actually, if you really want to know what is the stock investment, how to invest in stock, what are the 5 types of stocks you should buy safely and confidently, you just check out what's popping up on the lower right hand corner after this video end. Okay, and the other thing about equity is it could be, like I say, it could actually be packaged as an exchange traded fund as well, which a lot of people know for their low fees. And then of course you can also invest into equity via a unit trust or a mutual fund. So these are all equity, but they are just packaged differently. Now, the other thing is, you have to understand, which I'm going also to cover in this lesson, this equity in the form of stocks, mutual fund, or ETF, it just means that they have a different level of diversification, different level of risk, and expectation of return. Now, when it says return, when it comes to equity investment, there's always this called capital gain or loss, and if there's available dividend in the form of cash flow as well. Now, I also want you to check out after this video and how to invest in the best dividend stocks in Malaysia in anywhere in the world. Now I want to what is popping up in the upper right hand corner after this video, and just check out that, because this is one of our most popular lessons in the entire channel. Okay, now just moving on, the second thing asset class you can invest in really is fixed income. Now, what is fixed income? A fixed income, you can think of it like a direct or a retail bond, although direct or retail bond you cannot really invest directly because it normally requires a huge initial lump sum capital in a six-figure kind of capital initial starting amount. So, but still, for the sake of completeness, I'm going to tell you fixed income you can include like direct bond, and for people who are really starting out, who are really risk averse, you can actually invest into bond fund. Now, bond fund is a composition of different bond, a bundle of bonds inside a fund, right? So when they say unit trust or mutual fund, there's this called equity fund and also called a bond fund. Now, this is what it is about, right? And you could absolutely invest into a bond fund with little money, like as low as 1,000 ringgit. Now, there's also what we call as a cash or fixed deposit. You already know that already. It's capital guaranteed, capital protected, and it gives you not a return that is nothing to shout about. Now, of course, there are other things that you can invest in, but this is what I call as a non-market correlated, because equity and fixed income are actually assets or vehicle in a capital market. Now, if you really do not understand what is a capital market, you have to check out just now what I said about a Bursa Malaysia tutorial, what is this stocks about and all that. Now, non-market correlated investment, I could categorize that as a beginner for you, P2P lending. Now, what is P2P lending? P2P lending is basically you actually lending money, okay, through company. Normally, they are not listed company, they are smaller company, but you group your money together, you lend to this company. But the thing is, yes, you can invest with 1,000 ringgit. What I say P2P lending is for the poor, because P2P lending is just a minute or washed down or diluted version of what is what we call as a private equity investment. Like you buy stakes into company, let's say like Airbnb before they are currently listed, or even Uber and all that. So this is when you invest in a company which are bigger kind of businesses, what we call a startup or unicorn before they go public listed. Now that is called private equity investment. P2P lending is just a washed down or a small version of private equity investment, and private equity is really for the well-heeled investor, right? Now, the other thing, of course, you can invest into what we call as alternative or speculative type of investment, because there's no fundamental to it, all right? The thing that really determines the fluctuation of the price up or down is purely sentiment and purely based on supply or law of supply and demand. And this is one of the good examples is commodity and also currency, or some of you might know that as a forex investment. Now, this is the myth I really want to debunk for you. Now, volatility, people when they say there's a lot of volatility, they don't like it. There's a lot of fluctuation in their investment, they don't like it. They are very afraid they will lose money. But here's the thing. Okay, in the capital market, you can say yes, volatility is equals to a fluctuation of your investment, but it is absolutely not equal to risk. Why? Well, the risk, I would define that the risk, it means that the likelihood or probability of you losing money in your investment. But volatility, it's basically up or down. For example, if you were to invest you put your money in a fixed deposit, there's no fluctuation, there's no volatility. So the upside is only capped or limited at 3% per year. To actually get more than 3% per year, you need to accept volatility or fluctuation as part of the equation, because volatility, it could be up and could be down, okay? And you need volatility to actually gain an upside in your investment. Now, that is not equal to risk. Risk is purely about the downside risk. Volatility, it could be upside, it could be downside. What you want to avoid is not volatility. What you want to really avoid is downside risk, or to minimize the downside risk. So, there are a few things about this asset class that I just covered about the differentiation in terms of expectation of return. Now, for stocks, the expectation of return is high. You say, how high? Now, I have no answer for you, because it could go as high as 3 figures, 100 over, 200 over % in 1 year or 2 years. Now, I have personal experience. I'm not just talking only. I have personal experience experiencing 200 percent return in a relatively short amount of time. Now, I want you to check out this video, which I really show you in my trading account what is the exact stock I invested in that gets me 267% of return exactly, right? So you can just take it and learn from me as well. Now, the other thing about expectation return, now this is in a descending order. Stock, you can go very high, as I have shown you. You could go next, your expectation should be lower for equity unit trust, right? I specifically say unit trust because unit trust, you have equity and bond or fixed income. So I'm talking about equity unit trust. You have a medium high return. It's possible for you to get like 30%, 40%. Likewise, it could actually swing the other way, which we are going to cover as well. What is the expectation of the risk? So expectation of return, equity unit trust is medium high. For equity ETF is average of cost because it's passively managed. So you see that it would have average rate of return. Now, the thing I want to put in here is that I want to show you where does safe, so-called relatively safe investment like EPF or Amanah Saham Wawasan and all that lies. Now, EPF, as you know, no need to explain, pension fund. Amanah Saham is basically also a unit trust by Permodalan Nasional Berhad. Now, this lies around 5 to 7% per annum. The capital really, there's not much fluctuation, but this is the expectation. Now, what actually gets below EPF and ASP is what we call direct bond, whether it's direct or in a fund level, you have an expectation of return of medium low. And then also fixed deposit, what we already know, it's low. It's around 2.9 to 3%. Now, again, whether you can get a high or low return of this asset class, it really depends. It's very subjective. You can actually get very shitty or very low return for a stock compared to someone who invested in unit trust. You can get a 30%. Why? Because it depends a lot on what investing knowledge you know and how you're applying the knowledge. I'm talking about fundamental and technical analysis over here. Now, if you really want to know, really learn about how to invest, in Malaysia, in stocks and all that, or even in property, I have check out the description below. I have curated for you a playlist of all the things, the lesson on investment, how to do fundamental analysis especially, and a bit of a technical analysis in this channel. The list is in the description below. So after this video end, I really want you to check it out and just digest this lesson for free, pure value to you. Now, moving on, also I want to talk about the expectation of a possible loss, what a lot of people call volatility, but actually it's not. It's what I call as risk, downside risk, right? Nobody really complains when your investment is volatile, but it's volatile on the upside and it goes up like 10, 15, 30% in a year. Nobody really complains like that, right? You need volatility for it to actually get like 10, 20, 30% in a year. So now we are talking only about possible loss. Now, of course, we start with fixed deposit or cash deposit where the possible loss is zero. There's not possible for you to lose any money at all because it's so-called capital guarantee protected by PIDM. Now, of course, the next safest thing is EPF or Amanah Saham. Also, although they are not really capital protected, but I know historically that has never been a year whereby you actually lose money. So I would say as of now, it's a good enough kind of thing, next best thing, or next best investment compared to fixed deposit, I could consider is almost zero possibility of a loss. Now, bond, direct bond or even bond fund, now I would say it is rare for you to lose money for the capital, but it's possible that if the bond goes into a default, you have a direct total loss, right? Although that is rare, therefore I put it as the third one in this order. Now, of course, equity ETF is where you have your medium high risk of losing money. Now, and when I say losing money, meaning that you're losing your initial capital, okay? Now, of course, the next part is equity unit trust. There's also a high chances, especially for fund or unit trust that is not well managed, you could actually swing to the negative side as well. And for stocks, it could be high or it could be very, very high. And P2B, as you know, private equity, really it is only for those well knowledgeable investor who can actually stand even though they're going to lose their total initial capital, which I really want to have a slight opinion or comment on this, which is why P2P, I don't think the risk and the return commensurate each other. There's too much risk, okay, too much risk involved for too little return, which I could actually easily get from a unit trust, equity unit trust, or even an ETF, right? Or even a direct stock. So which is why personally, if you ask me, that is not something I would actually dabble in. Now, the thing is whether you have, whether how much you get and how much you lose, at least on during your holding period, right? It very much depend on what a lot of people say. Two things: whether you are informed or you are not informed, and whether you are diversified or you are not diversified. If you really are good and you do your homework and you practice what I call as informed concentration. Now, you can put all your eggs in one basket, but you know your eggs, you know the basket well, and you're watching over your eggs in that basket. That is what I call as informed concentration. All eggs in one basket, watch it well, know what you are doing. Now that could likely outperform what I call as informed diversification, like equity unit trust, whereby the fund manager pick a certain company or business that is supposed, and what they know based on the current facts is going to perform well, and that is what we call as informed diversification. Now, even though one company is supposed to perform well, you don't put all your money in there. You still diversify into other company as well, or maybe the competitor. So what you know is informed concentration could possibly outperform. Informed concentration could possibly outperform informed diversification, and then of course informed diversification, it would easily outperform uninformed diversification, which means that you actually diversify not without knowing why you want to diversify, and just you want to diversify for the sake of diversification. That is what we call as you're listening to hints, tips, rumor to actually conduct your investment. And of course, the worst of this bunch, if you don't know anything and you were uninformed, and you are putting blindly all your stake into a company or an asset class without doing your homework, that is where what I call as uninformed concentration, that is the worst that could happen to you. There's a lot of downside risk, but not enough expectation of return. Now, moving on, you might have a question: can I have expectation of high return with an expectation of very low downside risk? Now, let me ask you, can you have your cake and eat it too? Now, that is a very simple question. I let you to think about this question. Now, the other thing I want to talk about is about liquidity. How easy it is for all these asset class for you to actually sell and get back your funds or money. Now, for fixed deposit, you could literally if you go to now online banking, you could literally put a fixed deposit today. Tomorrow, there's an emergency, you need to use the money, you can liquidate it straight away immediately. Stocks or ETF, it could normally take 2 or 3 working days for your investment amount after you're able to sell it, for this amount to be back into your bank account. And any form of unit trust, at least from Malaysian perspective, including like Amanah Saham, it will take about 4 to about slightly more than a week to get back your money, what we call as redemption, depending on whether that unit trust is a local unit trust or is a unit trust or mutual fund that is located overseas. And the other thing is about direct bond. It varies because it depends on whether the bond matures. Normally it's number of years, probably 3 years, 5 years, or even 10 years, right? Until maturity, it is really not liquid. So be very, very careful on that. Of course, if you invested in a bond fund, then that's a different story. Now, ETF, of course, is very illiquid, but still, it's almost like capital protected. It's very illiquid up until your retirement age of 55 to 60 at the time of this recording. Now, the thing is, cost of investment is also another concern. I'm going to compare with you, just give you a quick rundown of the cost of investment, which includes what we call as a front end. It's front end cost involved, the back end cost involved, and also what are the costs of investment involved during the entire holding period. Now, you know the FD and EPF, there's literally zero upfront, back end, or even during the holding period. Now, for bond, I would say in most cases it's negligible, and could be low or usually low when it comes to stocks. Because the only thing involved is when you transact, right? If you don't transact, there's no fees involved. What we call is a brokerage fees of around 0.1 or even to 0.4 or something of percent, or even there's a flat rate, right? The thing is, if you are wondering how to actually open a CDS account, well, the easiest way to do that is to go through online, right? You don't need to even fill any form. Just type in your keyboard, pay 10 ringgit, and then just be open, right? You can actually do what I am teaching you to do over here. Now I want you to check out this another video lesson that's popping at the upper right hand corner, how to open an investment CDS account in Malaysia. Now that video is the best one, the fastest way to actually open a stocks brokerage account. Now moving on, you have this kind of cost of investment medium low. I would say like ETF, because the any exchange traded fund, because the annual management fee is only around 0.4% or so, or 0.5, and the brokerage fees that is involved during the buy and the sell. Now I would say average, but a lot of people might disagree to say that unit trust, or in general most mutual fund or mutual fund that is actively managed equity fund, the average annual management fee is around 1.5 to 1.8% compared to 0.4%. The thing is, if you were just to look at that without comparing it to the next asset class, you would think that these funds are generally, well, it's pretty high, right? Pretty high. And actually, a lot of people don't really complain it's high because of the 1.5 to 1.8% yearly. They're actually complaining because of this upfront sales charge of up to 3, 4, or 5%. Now, I can tell you this actually depends, because the prospectus for a lot of equity unit trust says that 5%, but practically it could go as low as 0%. Depending whether you're a priority banking customer, depending you are a client of financial intermediary like financial advisor or agent, that could actually lower down the fees for you, right? And that is what I want to actually show you. Now, I know that not a lot of people would actually invest in hedge fund, but if you are really aware of how hedge funds works, hedge fund charges around 2% yearly, and they charge an additional 20% on any of your positive return. Now, that is nothing really. If you look at this again, unit trust or mutual fund in general is nothing compared to what hedge fund charges. So for me, this, whether it's high or low, a lot of these things are actually pretty relative. And I hope this actually gives you a new perspective from an actual industry practitioner, as a licensed independent financial advisor myself. I can actually really give you a compact but most value lesson for you when it comes to this investing. Now the thing is, don't miss the forest for the trees. Don't be that fool. Now fees is only part of the equation, but you don't let the fees actually deter you from investing into asset class, or even something simple where a lot of people get started like an equity unit trust, because if you can get like 10%, 12% a year, what is the fees of 1.5% is about? Now I want to really crystallize this point and show you to say that, well, a lot of people say they invest into these ETFs. Now I want to show you, this is what we call as an ETF that tracks KLCI, right? The index in KLSE, Kuala Lumpur Stock Exchange. Now this ETF have a 0.5% annual management fee, but you have to look at what was the historical return from 2014 to 2018. Right? It's in 5 years kind of time frame, right? Yeah, it's low. It's an ETF or exchange traded fund. Now let me actually calculate that for you, right? Or calculate that together. Now, if imagine what is this ETF is basically a basket of the top 30 companies, biggest company that makes up the KLCI index in Malaysia. Right now, seems like nothing can go wrong. But the thing is, if you start with 1,000 ringgit, let's say in 2014, right? And based on the amount of return you get, like minus 3.55 or minus 2%, minus 0, 12% positive, and then minus 4.44%. You start with 1,000 in 2014, and then this is the exact amount of gain or loss you are going to get. And at the end of 2018, at the end of the 5th year, you are going to end up only 0.5% higher after 5 years, which is, you start 1,000, after 5 years, you just earn 5 ringgit. Now, this is the ETF for you. Okay. Now, in the same analogy, I want to compare one of the funds, which is called Kenanga Growth Fund, which again is an actively managed unit trust or mutual fund. This is how they perform over 5 years, the same period. Now, of course, there's stock picking involved. They do not only invest in the top 30 companies that track the KLCI index, right? Now, it comes with a 1.5% annual management fee. Now, if you start with 1,000 in 2014, and if I were to just follow the percentage over here, 9%, 20%, no gain, no loss, and then 25%, and then minus 18% in 2018. Now, you will still actually end up with 36% gain after 5 years, right? So the choice is pretty clear over here. Now, I saved the best for the last. My advice for you is just be prudent. If you really only have 1,000 ringgit with little money, do not invest that if that is all the savings that you have. I would rather you put into fixed deposit. And not only that, I want you to actually look at your monthly expenses and actually save enough in fixed deposit or whatnot that cover at least a minimum of 6 months, or even better 12 months of your living expenses, right? Because this is one of the best capital protected short-term investment that you can get. Now, don't get fancy. You do until you could cover 6 months minimum of your living expenses, and then only think about what really to invest into in Malaysia. Now, this might sound very counterintuitive. The thing is, you really should invest in yourself. If you only have like 2,000 ringgit, or even 10,000 ringgit, I think the best you can invest into yourself is knowledge, because you are the best investment you could ever invest into. Not any tools out there, not only asset class out there, but yourself. So I have more lessons coming up in this channel. If you get a lot of value from this video, this lesson, you click on like. And I also want you to actually let me know what are the other comments, feedback, or any question you have, type in the comment section below. And also, before you go, I would really appreciate if you subscribe and you click on the notification bell, so you actually get notified when I publish more useful lessons like this. If you found value here, do click on like, do click on subscribe, click on the notification bell. Just a free way for you to actually support CF Liu channel. That being said, I will see you again in the next lesson.